But I do think that this is what will happen. This is the concept of given good as well, where higher the price goes, the more demand, because people start to freak out. They took for granted that it was always there and always available. And because the West suppressed it, it was always cheap. Now it's disappearing and it's getting expensive.
If you maximize this opportunity, for which you now already have a taste, for which we have provided for you. So let us go and talk some more about silver, because this entire thing resolves at its first major target, but not its final top, at $333.
Silver, long dismissed as abundant and easily accessible, is being described as entering a phase where rising prices may actually accelerate demand rather than suppress it. Andy Schectman of Miles Franklin Media predicts that as silver moves higher, investors and institutions will react with urgency, realizing too late that decades of price suppression created a false sense of limitless supply. Once that perception breaks, silver may behave less like a traditional commodity and more like a scarcity-driven asset where fear, not valuation models, drives buying. This argument is framed alongside a comparison with gold, whose price history reflects deliberate restraint over decades. Gold was historically capped through futures markets and coordinated flows between New York and London to support low real interest rates and financial asset inflation. In the present environment, gold is increasingly viewed as the monetary anchor of the system, while silver occupies a more complex role. Unlike gold, silver is consumed. It is critical to defense systems, digital infrastructure, solar panels, and electric vehicles, making its depletion structurally different and more dangerous in periods of rising demand. The discussion highlights structural vulnerabilities in the silver market, particularly the dominance of paper instruments such as SLV, the world's largest silver trust, custodied by J.P. Morgan and BlackRock. Most investors cannot take delivery, meaning ownership is largely symbolic. Reports cited in the discussion suggest massive physical accumulation by custodians alongside the removal of large quantities of silver from COMEX deliverable inventories. Andy argues that arbitrage flows are accelerating this drain. Silver consistently trades at a premium in Shanghai, incentivizing traders to buy in Western markets and deliver into China, permanently exporting physical metal. China, eager to reduce dollar exposure, appears willing to pay higher prices to secure commodities directly. Before we dive deeper, don't forget to like, subscribe, share, and hit the bell icon so you never miss any of insights and market updates.
Well, yeah, I mean, and you have J.P. Morgan and BlackRock as the custodian of the world's largest silver trust, SLV, the same company who paid a $920 million fine to the Justice Department for suppressing or spoofing the metals market, is allowed to be the custodian, along with their pals BlackRock, of the world's largest silver trust. You would think it would be far easier and more palatable for the world when they look at the world and say, well, what? All we did was close SLV, unless you have a basket, which would be millions and millions and millions and millions of dollars worth. These are the people that actually fund the account typically, like the commercial banks. None of us can take possession of it anyway. So it's an asset that tracks the price, or it's an ETF that tracks the price of silver. And not even that great at that, but it is the largest silver trust in the world. And it would be far easier for JP Morgan to close that account, pay everyone their fair share of what their account was worth at the end of business on Friday, and say to the world, all we did is what the prospectus allows us to do. Now you're sitting on a huge stockpile of silver without breaking any laws or infringing any civil liberties. And, it gets interesting when we talk about JP Morgan, by the way. The Economic Times just came out with a report saying that they hold over 750 million ounces of physical silver, and that's worth more than $40 billion. And it would be the largest stockpile on the planet if that were the truth. The fact that they moved somewhere in the neighborhood of like 166 million ounces of silver. They moved it 169 million ounces of silver, and they moved it into what's called a non-deliverable vault. Now, this was something that was new to me. I dig in a little bit because I thought either it is or it isn't in the COMEX ecosystem. And it technically, these 169 million ounces technically they still exist on paper and could be moved into COMEX, but it's legally removed from the delivery system, and it cannot be used for COMEX settlement unless it is re-registered. So, not only have they accumulated 750 million ounces of silver, and they have forever always been the biggest short, but they flipped from short to long. They added 21 million ounces while closing a 200 million ounce paper short, according to this article. And then at the same time, 16.6 million ounces left the registered category, left the building. Goodbye, silver. And 169 got moved into vaults outside the COMEX deliverable status. This is not defensive posturing at all. This is intentional removal of metal from the delivery pool. And if it is true, it marks a huge shift from suppressing silver with paper to accumulating physical metal. And you want to talk about bullish. At the same time, and you can stop me anytime here, COMEX deliveries have been unusually large all year, Kaiser. In November, which is typically not a delivery month, we had almost 17 million ounces of silver and about 1.5 million ounces of gold that were delivered. In both cases, gold and silver, it's not a delivery month. By just the 12th of December, deliveries have already reached 58 million ounces of silver and almost 3 million ounces of gold, with contracts still being added daily. For years, gold and silver has flown back and forth between the COMEX and the LBMA, and these Western banks were in concert together to suppress the price of gold and silver. Now, silver, I would argue, was suppressed for the military-industrial complex. That wasn't just the United States. It was France. It was England. It was all of the Western countries that had strong militaries that used that to keep their thumb on the world, so to speak. And at the same time, gold was used to hold down the price of gold, largely through futures contracts where they go short in New York to drive the price down and go long in London to offset their books, and metal would flow back and forth. And this was done in cooperation between all of the banks in the West. Gold was held down because of something called Gibson's paradox, which speaks to the inverse relationship between real interest rates and the price of gold. So if the West suppresses interest rates for 30 years to create an illusion of prosperity in our 401ks and our house values and keep everyone, borrowing from the bank, using currency, buying bonds, all of the things that the Western bankers would want, you step on the price of gold, right? So this has been going on forever. Well, Trump says, we need to bring all of this gold back because there's tariffs and silver. So, don't worry, it'll all flow back. Well, the tariffs aren't there for this. This was about reshoring, right? So all of this metal has come back, leaving the Bank of England rather vulnerable in terms of the LBMA, in terms of the short positions that they have. And this is a big deal, right? Because you have 140 million ounces, but contracts that say 2 billion ounces can stand for delivery. Where's it going to come from? This is an existential threat. It's higher, and that's to attract arbitrage. The dummies who will buy it in New York and deliver it in China, that's what they'll do. And they've been doing that for a while. In other words, if you are a trader and have the ability to buy it around the world and deliver it using the COMEX price and then deliver it in China, you're making a hell of a lot of money on that spread. Well, but you're also giving away the silver that will never come back. So that is true. And there is a guy named the Oriental Ghost on X, Bai Jing. I can't pronounce his name. I'm not even going to try. His first name is Bai, Bai, and then the last name starts with an X. He's known as at the Oriental Ghost, I believe is what it is. He posts the closing numbers on the Shanghai Exchange every day, and you'll see that silver is always a couple bucks higher there than it is here, which is specifically trying to entice the arbitrage to, we'll pay more money for it. Sure, send it to us. Thank you very much. Here's your dollars. And they would like to de-dollarize anyway, so they're using the surplus of dollars to buy up commodities around the world, which is why you would expect to see dollar use increase towards the end of the dollar's life as people are trying to hot potato it, get rid of it, and buy assets like silver. So I think that's what he's seeing.
Silver at $333 is not presented as a speculative fantasy, but as a technical destination the speaker argues is only a first major milestone, not the final peak. The projection is framed as the natural outcome of a long-term pattern breakout. where momentum accelerates precisely as fundamentals begin to confirm the technical picture. According to Francis Hunt of the Market Sniper, silver has already exited its base, cleared major resistance, and entered a phase where speed rather than hesitation defines price action. Within this framework, gold serves as both a comparison and a measuring tool. In the past, gold's price was restrained by policy, rate suppression, and coordinated financial mechanisms designed to stabilize debt-driven systems. In the present, gold is depicted as reasserting itself as a monetary reference point, with projections moving toward the $9,000 range under a compressed gold-silver ratio. The contrast is clear: gold reflects systemic stress, while silver reflects both monetary and industrial scarcity, creating asymmetry in potential upside that places heavy emphasis on ratio dynamics. A move toward a gold-silver ratio near 27 implies silver dramatically outperforming gold, not because gold weakens, but because silver accelerates faster. Under more extreme conditions, single-digit ratios are discussed, scenarios in which gold advances further but silver multiplies exponentially. Let's get back to the video.
So I'm going to show you how small this pattern looks when you incorporate without the log scale, which you should have, by the way, but we're just showing it for special effect, how it looks. So we are once again going to put that famous number in, 49.81428, 49.81428. There we go. And we're going to stick him in and see if we can get our draw to come showing up. So 91. I say between interims, you run hard, you run with real speed. And you are already in that phase. You cleared the 41 with quite decent aplomb. And suddenly the fundamental news is validating your technical setup. You hear stories, YouTubes are coming out that are saying Samsung executives flew into, wait for it, flew into Mexico to secure huge amounts of supply, and they are paying premiums. Some people suggested $73. Some people suggested all sorts of numbers that are significantly larger, just to get guaranteed supply of silver, friends. And that 333, just so that you know, if you think we aren't courageous and aren't ready to throw out big targets, that 333 is up here. It's up here. There's 333 from that original main pattern break at around 31 and the primer roundabout Brent Johnson's, kind of like Gordon Brown's bottom of selling gold. The Brent Johnson pilgrimage quote, that over there. This is how far you've got to go in percentage terms. This is your silver. And sadly, all other commodities, things that you eat, things that you use, that building companies are also going to be moving. This is your measuring tool. Let's just take it from the Brent Johnson key moment. How wrong will he be in percentage terms on silver? If our target is met, he will be 1,270% out on any shorts he took, if he did ever back an opinion with a short. 1,270% up. That is, friends, 13.7 times. 13.7 times that $25. If we measure it from where we are now, it will obviously be slightly less spectacular. And we tell you that we'll only close a portion at this juncture. We will only close a portion at this juncture, and it's still 418%. We're talking 5.2 times still to go at the 60 before you have some respite and rest. And then you go 4 digits and single-digit gold-silver ratio. We expect this to occur round about 27 on the gold-silver ratio, friends. 27. Gold-silver ratio. We have a downside target of gold down there. Gold will be around 9K, we expect, and silver will be around 333. That's right. And you will have a 27 gold-silver ratio. And if you go single digits on that, it's likely gold will go 10, 12, who knows? And single digits means 1,200 silver if you're 12,000 gold. if it's 1/10. So 9.99, you'll be at about 1,200 silver. 1,200 silver at 10, 12,000 gold will be amazing. And if we were to go to 1,200, well, I'm going to have to use the log scale, I'm afraid. It's just too big a move. But let's just measure it from here. What percentage would you be going to 1,200 from here? Well, because we've gone log scale, it doesn't look like much, but you will be back at 1782%. It's almost as if we're back down at the $25 going to 333. That is 18.8 times. 18.8 times. Call it 20 for a rounding error. You could be 20x from your current levels of $64. And you've got one of them that spans, in actual fact, around 46 to 64. 46 to 64. You're talking almost $18. We used to cheer making a 25 cents. $18 quarter. You've just had yourself an $18 quarter. Most people getting inside our HVFs that we were making a fuss about and saying it's the biggest, the grandest of ever, and when it runs, it's going to run like a bitch on heat. It's going to run. Boy, oh boy, oh boy, it's going to have half the male population running after it. It's going to run like you've never seen. Now they're going to put some rate increases on there at the same time as America is cutting. America did a cut and is still potentially going to do a little bit more, and the US 10-year is going up on the cut. The long ends, particularly 20s and 30s, are going even further up than the 10-year. This all while, for the last 5 years since 2020, the average inflation has been 4%. You're sitting just under 3. Your target is 2. So you're 50% over your target, and actually over the last 5 years, you've averaged twice your target, and you're cutting rates and doing bank-based support repo, not QE. That's right. The banks are bust. It isn't being spoken about enough. The banks are bust, and it is not being spoken about enough. We keep mentioning that. You don't have a debt crisis, a debt and fiat-based crisis, without recognizing that the biggest intermediary and issuer of that debt are the banking institutions, and they're being kept alive. And the Fed is buying 40 billion to keep them and their repo market going. So the likes of the Cayman Islands Ponzi can keep running so that they can still have buyers, inverted commas, buyers for their debt overreach. That's right, because it's not China that's buying more. It's not the other nations that's buying more. It is the Ponzi scheme, the local CIA dark state guys that are running the scam for them in the Cayman Islands. Everything is a fraud. It will all be exposed in due course, but you have to take it from me. It's very much like what CV19 was. Anyway, up, 6.874. You are now at 3.7. You're now at 3.7. It looks less ridiculous now, friends, than it did at 0.79. But let me just still, in case you think it's an easy call, just remind you that's the regular scale. The regular scale. It's still an immense move to go from there to there. In fact, you're probably just over halfway. We're still calling a near double in the rates. A near double in the rates. That's right, a near double. Not quite, but probably 1.8, 80% plus onto the rates. That is what HVF method does for you, and it's what it does for all of us on calling debt-based higher rates. That's why everybody who says bonds are a buy, everybody's become so negative on bonds. You've got to flip when everyone else is negative now.
Both analyses point to a market environment where price discovery is no longer being driven solely by traditional valuation metrics, but by structural pressures building beneath the surface. Silver emerges as the focal point of this shift, caught between its historical role as a suppressed monetary metal and its modern necessity as an industrial input. Gold appears to be reassuming its function as a systemic anchor, reflecting stress within currencies and debt markets rather than speculative excess. What ultimately ties these perspectives together is the implication that financial instruments and policy responses may be reaching diminishing effectiveness. As inventories thin, delivery demands rise, and arbitrage channels redirect physical supply eastward, the gap between paper pricing and material reality becomes increasingly difficult to bridge. Whether the outcomes unfold gradually or abruptly, the central uncertainty remains how markets, institutions, and investors respond once scarcity is no longer theoretical but visible in price behavior and settlement mechanics. As delivery demands rise and inventories thin, the imbalance between paper claims and physical supply becomes harder to dismiss, raising a final question. What happens when the next price surge is driven not by speculation, but by the simple inability to source the metal at any price, and how does a system built on paper claims adjust when price begins to reflect physical reality? If you found this analysis valuable and want more serious macro-driven insights into gold, silver, and the global monetary system, make sure to subscribe. This channel is for investors who care less about hype and more about understanding.